Welcome to WealthStep's Aim, Save, Invest, and Spend Financial Literacy Education. WealthStep is where you solve your financial future. What is WealthStep? It's online guidance to help you achieve financial independence, to prepare and be retirement ready. There are tools for plan participants, free advice for people in 401k plans or other plans that use WealthStep portfolios. There are services for WealthStep direct clients outside of retirement plans, individuals who use the online advice tools and have portfolio management by WealthStep. And there are tools that are free to the general public to help provide guidance and education. WealthStep's focused on what matters. It provides automated advice and a process proven by experts over time. And it provides action reminders, learning opportunities, and reports to help you stay on track. It's all about aim, save, invest, and spend, and doing it wisely. And it's simpler than you think. The key reason that it's so important is that most people are part of what you might call the first 401k generation. In the last few decades, for the first time, people have been responsible for their own investing and saving, whereas a more traditional retirement plan, if people had retirement plans at all, it was taken care of the company for them. So now it's in your hands, and you need to make sure you plan and start early and take the right steps in the right order to increase your chance of retirement readiness and financial independence. If you're in a 401k that utilizes WealthStep, there are a combination of providers that form that 401k. One is WealthStep for the advice about saving and investing. There's a custodian bank, and that will vary by 401k plan. There's a record keeper, which also may vary by 401k plan, and that record keeper is the organization that receives your payrolls and processes them into your selected investment structure. Retirement plans are a company benefit designed to help you create retirement income. In self-directed plans, those decisions are yours about how to save and invest. There are some rules and limitations. The IRS rules include the ability to save a maximum of $18,000 per year, or $24,000 if you're age 50 or older. And if you don't have a retirement plan and you're putting money into an IRA account for the tax benefit, the maximums are lower. You can take money out of most retirement plans at age 59 and a half without any IRS penalties. And if you have over $5,000 in a plan, you can leave it in the plan, even if you leave your job for whatever reason. By law, the company is required to allow you to keep it in if you wish. It's also very important to note that you want to avoid what's called cashing out. If you take money out of your plan, if you change jobs and put it straight into your checking or savings account, you will incur taxes and penalties, and that can harm your financial fitness. Each plan may have some different rules that the company defines as well regarding the type of contributions that are allowed, eligibility, the investment menu, and so forth, and whether or not the company makes a match. If you are lucky enough to work at a company that has a match, make sure to get that boost. That is free money that you can't go back and get after each year passes, and that can make a dramatic impact on your financial fitness. Oftentimes it requires that you put in money in order to get that match, but that is a great way to accelerate your financial preparedness. That preparedness can help you avoid becoming one of the statistics. The average person between the age of 55 and 64 has only $100,000 saved for retirement. If you use something called the 4% rule to estimate how much you could spend of that $104,000, that would be only about $350 a month if you wanted to have spending without running out of money before the end of retirement. Some people will count on Social Security, and the average monthly amount for Social Security is just over $1,000. And that's not going to be enough for most people. It will help, but it will generally not be enough. If your health is good, you'll have fewer health costs than the average person, but studies show that the average couple has $200,000 of health costs during retirement. That's about $100,000 per person. So the key pillars of retirement readiness is aim. How much are you going to need to begin to stop working? It's not about a specific age in terms of retirement. It's about when you are ready, and that depends on how much money you have and the spending you plan to do. It also then is a choice about when you start. Then there's save. Some people say, and some studies suggest that if you save 10 to 15% or more starting in your mid-20s, you may achieve your retirement goals if you invest wisely. If you start older and haven't saved anything enough prior, you may need to save more, and WealthStep can help you figure out those numbers in both cases, whether you're younger, middle, or older. Then there's the investment question, and the biggest challenge there for many people is investor behavior and making sure that you're taking the right risks, and we'll talk about that. So let's imagine, just for 10 seconds, what your retirement will look like. Try closing your eyes, thinking of where you'd like to be, how much you might like to spend each year, and what the feeling is that you want to have when you're in retirement. Some studies show that just by imagining your future, it can improve your chances of getting there because it raises it on your radar and you think about it in the context of other decisions you make, and it may cause you to save more and to plan more wisely. So how much will you need in retirement? That same 4% rule can be helpful as a very general rule of thumb. The WealthStep advice tools can be more specific and accurate than the 4% rule, but the 4% rule is a good, very general starting point for simple math. So if you have $1 million at the start of your retirement, that means you could spend 4% or $40,000 a year, which would be about $3,300 per month. If you add in the average Social Security number, you end up with about or 4,400. So you get to decide whether that's enough for you for what you hope to do for spending. That's about $53,000 per year. Some people will need more than that to achieve their spending goals and their retirement goals. For some people, it's less. So you determine what that is, and WealthStep.com will help you figure out the right amount to be saving now and in the future. This is important because you need to get ready for a long life. People are living longer and longer, and there's a 25% chance that you will live beyond the age of 92 to 97. That's what we call longevity risk when people refer to having your money run out before you run out of time. And there's some reasons that people don't typically save enough. There was a study done a few years ago that indicated that younger people don't save because of how the brain works. They tend to save less because they simply don't visualize the future in the same way that people do who are a little bit older. So what the study did was took pictures of people and did simulations of what they might look like 40 or 50 years later, and all of a sudden people started saving more. And the study suggests that it's because it created neural networks in the brain, connections in the brain that associated the future with the present, and people responded by saving more. There are apps for that can be fun to play with and are worth trying and using with your friends and colleagues, and it might just lead you to be a better saver in the process as well. One thing that helps take the sting out of saving and allows you to save more than you can think is the tax benefit of using a retirement plan or an IRA account. So we sometimes call this the government match, because if you put money into a retirement plan, you are not taxed. In the traditional retirement plans, you're not taxed on the money that goes in. You will pay tax on the income that you take out as income in retirement, but by putting it in without tax earlier in life, you are able to put in more, which allows it to grow more, which provides a benefit, a higher dollar value over time. So someone who starts and has a $50,000 salary, that would be about $4,000 before putting anything into a retirement plan. Someone put in 10% of that into a retirement plan would be about $400. Paycheck, however, would only be reduced by $259, and that difference, or that extra amount of $158 that would otherwise go to tax, goes into the retirement account. That's a 38% additional savings that the government provides as an incentive for people to save. The government doesn't want people to be heavily reliant on Social Security. Then again, the match, if you have a match, that can create another big boost. And when you combine those two together, that can really lead to a powerful savings amount that is bigger than what you could do just on your own. Another key element to why it's so important to start now is the power of compounding. You want to pay yourself first. So when you're designing a budget for how much you're going to spend on rent and food and everything else, think about a budget item for your future spending needs, not just today's spending needs. And if you save early and you save consistently, and in this case, if you start at age 25 and put in $5,300 per year, by the age of 65, if you use WealthStep type portfolio designs by life stage, you might end up with about $1 million at age 65. If you wait until 40 to start that, you might end up with 300,000. If you wait until 55, about 72,000. Big number differences. So by putting in $80,000 more, if you start at 25 than age 40, you end up with almost $700,000 more because of the power of compounding. Another way to think about this is that if instead of putting in $5,300 starting at age 25, if you wait and start until age 40, you'd have to put in $17,000 a year to achieve $1 million goal, or $80,000 a year if you start at 55. So the sooner you start, the easier it is to get to a bigger goal. And even if it feels like a lot to start with now, you'd be surprised what it can accomplish. And 5,300 could also include a match. So the amount of money you put in might not even need to be a full 5,300. That would amount to, by the way, about $15 per workday. And most people, if they look at their cable bill or coffee habits or other elements, have been surprised that they're able to come up with, positively surprised about how their ability to come up with extra dollars to put into their retirement account to achieve some of these bigger numbers that they're hoping for over time. So what do the investment structures look like? If you're in a 401k or other retirement plan that uses WealthStep, or if you're a WealthStep direct client, the general idea is that even if the portfolios vary a bit, whether it's a target date fund or a target allocation fund, the basic idea is whatever combination of portfolios you have at your disposal through WealthStep, which will vary by retirement plan, etc. The idea is you start with a higher amount of stocks and gradually reduce those stocks and increase bonds over time as you go through the different life stages. So what are average returns in the long run? What is a reasonable return? What should your expectations be? Most people think about returns being whatever have been the recent returns in the last few years. That's generally, however, not the best way to estimate what the long run will be. So if it's been a very strong market or a very bad market, that does not mean that's what it's going to look like in the future. The average return for the stock market over the last 80 or 90 years has been about 10%. For intermediate government bonds, about 5%. For short-term bonds, about 3.5%, and inflation has been at about 3% in the long run. The 10-year projections looking forward are about 7%, 3%, 2%, and 2.3%. So a little bit lower than the long-term average, but that could pick up again in the longer run. This is just sort of a medium return number to help you manage your expectations. The economy is growing a little bit more slowly currently than some other periods. This chart illustrates the variability of investment markets over time. Each column represents a year from 1997 through 2016, and at the top of each column is the best performing asset class for that year, and the worst is shown at the bottom. So each color is a different asset class, whether it's US stocks or foreign bonds or real estate or any one of a number of different asset classes. And what you can clearly see by looking at this chart is there is no clear pattern. Every once in a while it looks like there's a pattern. For example, here you've got emerging market stocks in orange that tended to do very well from 2003 to 2009, but then boom, boom, had several years where they were much weaker. That's the same or similar pattern with other asset classes. You cannot predict what's going to happen next. And the Nobel Prize in Economics was awarded to someone who came up with the concept of diversification, where if you put all of these asset classes into one basket, into one portfolio, then you reduce your overall volatility relative to holding some of those asset classes individually. You always capture the best returns, and you never have too much at any one point in time of the worst returns. That's the idea of portfolios and diversification. Inside the portfolios, there might be any one of an array of asset classes. WealthStep custom portfolios for 401k plans might vary a little bit from other plans, and WealthStep Direct has its own unique mix of asset classes, all of which are highly diversified. And the idea, again, is to have an array of assets that behave differently in different time periods to create that diversification effect. What that diversification effect can look like, if we take a very specific example of an airline and an oil company, is this. So oil is the biggest cost of doing business for airlines. So when oil prices are high, an airline's profitability and therefore stock price may be low. When oil prices are low, airlines tend to do better. An example from an actual time period of an airline and a fund containing oil stocks looks like this. When one was up, the other was down. Combining these two assets together creates a smoother ride. It's never a straight line, but it can be a smoother ride than holding them individually. And when you have a well-diversified portfolio, you might have thousands of stocks and thousands of bonds, so that one's going up and the other's going down. On average, you have a smoother ride. This chart is busy, but shows the 4 worst stock markets in history. The Great Depression in gray, down 79% at its worst point. The dot-com crash and recovery in green, the oil and financial crisis of the 70s in red, and the global financial crisis and recovery in blue. The black line here shows a typical pattern of a market dropping, a fast initial recovery, and then a slower gradual recovery over a period of time. The key message here is that it's not entirely abnormal for markets to have a significant drop. It's not usually as big as the charts shown here, the lines shown from these different markets. But when it does drop, it can drop pretty quickly. And when it rises, it can rise pretty quickly. The key message here is that in all of the cases, the 4 worst markets in history, they all had full recoveries over time. It can take a while. It can take 2, 3, 5, 7 years, depending on the market, depending on the type of reason that the market cooled off in the first place. But markets do recover in the long run. And one thing you'll notice here, there are periods when the market drops very quickly. That's because of what's called the auction effect. So if you have more sellers than buyers, a price can drop very quickly. And if people are on the sidelines and are simply not buying because they don't want to buy or sell, then the people who are in a panic and say, I absolutely must sell, will sell at increasingly quickly dropping prices. Then, when people realize that the market has been oversold, oftentimes there's a very quick initial recovery. The markets jump up, and it's hard to predict. It's impossible to predict when that will happen. So even if markets get tough, in the long run, you want to stay in it to capture the benefit. If the market drops and you get out, you have experienced the worst part of volatility, but then you fail to benefit from the upside of volatility. Another way to describe this is what's called a buyer's strike. When the market is going down, it's because oftentimes not so much the fact that some people want to sell, but if some people are panic sellers, selling out of fear, and there are few people who want to buy, that's a buyer's strike, and that can cause the price to drop dramatically. The other element shown here is that some people wait until the market is strong, then get in, missing the rise, feel the drop, get out not wanting to feel more of a drop, and then miss the recovery. And that can do a lot of damage. That type of cycle of market emotions can do a lot of damage to your financial future. Another way to think about emotional investing is that most markets are driven by a combination of the growth rate, inflation rate, interest rates, exchange rates, and a little bit of fear and greed, as well as other factors. But when something causes concern, oftentimes panic takes over and all the other factors go out the window. Whether it's geopolitical, political, or some other factor, sometimes it can cause that type of effect. Studies show, unfortunately, that type of behavior and panicking leads to worse results over time. The U.S. stock market, in one study, is shown to return 8.2% per year over a 20-year period. And the average investor in stocks had a 4.7% return. That's a 3.5% return less than just being in the stock market and doing nothing. So being an active and panic investor harmed people's results to the tune of about $200,000 over that 20-year period. If you started with $100,000 relative to just putting it in and sticking with it. This is called a behavior gap, and the way to resolve that is through a disciplined process. So what's scarier to you, a spider, a snake, or a sports car? Most people say the spider or the snake, but why? Well, it has to do with brain science and survival instincts. Statistically, however, a car is more dangerous. But what does this have to do with investing? Well, people tend to panic when there's a tough stock market as if it were a physical danger. It has to do with brain science and how people respond. They tend to respond as if it were a spider or a snake, even if the danger is lower than what they think. In fact, when people panic, it often does more damage than riding out the market storm, as shown in the numbers we talked about just a moment ago. This would be a little bit like throwing away your car just because you had a flat tire. So why does that happen? Well, if you think back years and years and years, when people were sleeping in huts or sleeping on dirt floors or with no shelter at all, spiders and snakes were a much more serious threat. And so we developed an instinct that remains today that some people still have a strong response to when they see a spider or a snake. It's a survival mechanism that isn't quite as helpful today as it used to be. But the car is a good analogy because there are risks to driving. But you reduce the risks by getting training and sticking to the road and driving with your eyes open. So remember, when markets get bumpy, think of those markets like a car, not a snake, like a curvy road that's necessary to get from point A to point B. Studies also show that taking deep breaths and walking around the block can calm that fight or flight reflex, which leads to better long-term decisions if you stay calm. The fight or flight reflex can be critical and can save your life when you're crossing the street or being chased by a bear, but it's usually harmful in financial matters. Trading can be hazardous to your wealth versus a long-term discipline approach. So don't confuse financial fear with physical fear. Time can also reduce that market volatility risk. This chart shows how over a one-year time period, the blue lines here are positive returns. The gray lines are negative returns. So there are quite a few one-year periods that were negative. More positives than negatives, but still quite a few negatives. Over 5 years, very few negative 5-year periods over a long time horizon, and even fewer, very few in fact, over a 10-year period. So just waiting and just being patient and sticking with it can actually reduce your risk. It's also important to note that investing is not gambling like many people think. Gambling has low odds, always less than a 50% chance of even ending up with a penny, and in some cases as low as 23% or worse. Whereas investing has a 75% chance in any given year of having a positive return. And over a 15-year time period, it's almost 100% chance that you'll have a positive return. So again, just being patient and waiting and sticking with it pays off over time. Additionally, if you get out of the market as an emotional investor, one of the worst risks is missing the strong recovery days. So someone who missed 0 recovery days after a bad market, in this study over this 20-year time period or so, had an 8% return. Someone who missed just the 5 best days of the market during that 20-year period had their return reduced to 6%. Missed the 10 best days, average return only 2.1%, and you missed the 20 best days and you would have had a negative return. It's so critical to stick with it. If you're going to experience and take on the volatility, you want to get the benefit and the upside of volatility to help you achieve your goals. Some people wonder how politics impacts the markets. Well, this chart illustrates different major U.S. parties over time charting the stock market corresponding to the different political party. And the conclusion is there's really not a major difference between parties in terms of the market. A bigger impact is actually the federal funds rate. When interest rates rise, the market tends to cool. When interest rates drop, the market tends to heat up. So that's a bigger driver than politics. And when the market does drop, here's something to turn that concept on its head. You might actually benefit from being happy about the market dropping on occasion because there is an upside to downside. When the market drops, it means that stocks prices have dropped and the whole world is essentially on sale. So if you are putting in new money as part of your regular savings program or your portfolio is being rebalanced, you're buying stocks on sale, and that can actually increase your account values over time. You want to be in the profit group, not the panic group. So if you know someone that is in a panic and they insist on getting out of the market, you might want to ask them if they can do it on the same day that your money goes into your account. So if they're going to magnify that auction effect, they can do you a favor and allow you to get in at lower prices. It's a little bit counterintuitive, but that's how it works. There are studies also that show that the more people look at their accounts, the worse their results are. And this is primarily because the more people look at their accounts, the more likely they are to get concerned or panic and reduce their average stock exposure over time. So people who look frequently may have worse results, and sometimes when we speak with people who are a little embarrassed to say they don't look at their account very often, we congratulate them. If they are in a life stage and needs appropriate portfolio, one of the best things you can do is not pay too close attention to it. You want to set it up properly and then leave it alone until you have an appropriate need to make a change. Sometimes this is referred to as set it and forget it. That doesn't mean you shouldn't monitor, and you shouldn't go back to WealthStep.com and make sure you're saving enough and investing wisely. You should do that, and you should check especially the savings rate yearly, because your income and spending needs may change over time, and you will probably want to increase your savings gradually over time depending on your personal circumstances. Inflation, however, is a risk that you should be concerned with and is much worse than volatility in the long run. In fact, $1 over this time period, which had a little bit higher than average inflation in the U.S., 71 to 2002, about a 30-year time period, $1 over that time period was only worth 21 cents in terms of purchasing power. That's about an 80% loss of value. And that 80% loss is worse than that 79% drop of the Great Depression stock market, the worst stock market in history. So you tell me, what's worse, inflation or the worst stock market in history? Especially if you consider that the stock market always recovers, but there's no recovering from inflation. As an example, a major hamburger chain in 1971 charged 60 cents for a burger. In 2002, it was up 400% to $2.40, and now it's $4. So if you are not investing wisely and using volatility to your advantage to get some of that returning growth over time, consistent and appropriate with life stage, then you may not have the funds you need when you hope to stop working to be able to buy the things that you need to support the lifestyle that you want. Another way to think about risk is similar to the chart we showed earlier, which is that the younger you are, the more willing you should be to take on volatility risk in order to fight inflation risk and to fight longevity risk. That increases your growth of your assets. And then as you pass through time, to decrease the stock exposure and increase bonds to reduce volatility during the period when you would be spending the money. The reverse is the case that sometimes happens, and unfortunately is happening to a lot of people in the 25 to 35 age range whose primary experience with the stock market has been the global financial crisis, and are still a little bit shell-shocked from that. So what those people in some cases are doing is being too conservative in terms of volatility risk and holding less stocks now, but they're being very aggressive in terms of inflation risk, which can do more damage over time. So you want to follow the right pattern to fit your life stages over time. So again, different portfolios by different WealthStep program, but the overall pattern is the same. Using risk properly, the right kinds of risks at each life stage to increase the chance that your total financial picture will work well. You should also note that Social Security has the effect of being like a bond. And so even if you are relatively high in your stock exposure early on in life, your net or effective stock to bond exposure is lower than what it would show in your portfolio when you factor in Social Security. Another way to think or be aware of stock market volatility and patterns is to see that the expected returns are lower as you increase bond exposure, and that is part of the plan. This is 4 portfolios just as an example along the risk-return spectrum, and each portfolio has a statistically projected high range in any given year and potentially low return. So the more stocks you hold, the lower the potential return in a bad year, but the higher the return in good years. So it's important that you be aware so that you're not surprised that something like this is normal, both on the high and the low, but not to expect either to be the normal case. On average, it should come out over a 10+ year period to something like what's shown here as the expected return. It's also valuable to remember that it can be very helpful to have an emergency savings. Sometimes some suggest about 6 months worth of salary. And when you are in retirement, it can be helpful to have 1 year's worth of spending cash not invested at all, so that there is no market volatility at all that could impact your immediate spending money needs. So there's a number of different types of risk that we've talked about here. The key message is that volatility is the only risk that has a reward. All of the others, while not as obvious or noticeable in the short run, are some of the most damaging in the long run. And you want to take that risk, price volatility, and incorporate that into the other smart risks that you take every day. If you drive, eat, or work, there's some risk of car accident, food poisoning, or a difficult day at work. But the no risk option, if you decided not to take on these risks, you'd never leave home, you might starve, and you could be homeless. And so investing is similar. If you take on price volatility, that price volatility is caused by uncertainty, but it tends to have a reward in the long run. The no risk option is actually not a no risk option. Sometimes it's the worst risk of all, which is that you might struggle in retirement. So if your goal is to get from point A to point B, if these are one of the acceptable levels of assets that you need in order to live the retirement or financial independence lifestyle that you want, then clearly this point doesn't work. It can be a bumpy road to achieve the goal, but if being too conservative, quote unquote, in terms of investing early on might feel comfortable now, but if it leads you to a path that diminishes greatly your ability to retire at all, then it might not be conservative at all. It might be the most aggressive risk, but just thinking in terms of retirement readiness risk rather than simply stock market risk. So keep your eyes on the prize and use those life stages for investing and save sufficiently and use WealthStep as a tool to help you with those different components. And if you aren't sure you can do it, there's a chance you have a limiting belief. You have overcome challenges in your life before, some that you maybe never imagined that you might be able to overcome, and you can do the same now with financial readiness, retirement readiness, financial independence. Be aware that you might have a limiting belief. Tear that belief down, build a different one using a plan. WealthStep can help you be the plan and create the plan that will help you get there, and it really begins with just one step. So WealthStep can help make that happen for you. Create a plan and stick to it, and then adjust it gradually over time. Take a look every year to see if you should be saving more or less and what the appropriate portfolio for your life stage might be and your circumstances. There are cases where people have situations that are more complex than what WealthStep can handle, and in those cases it may be appropriate to consult a professional fee-only financial planner that's an objective resource for those complex situations. So you want to focus on the things that you can control and the things that matter. Use the tools with WealthStep that you have at your disposal. It will help you aim, save, invest, and spend, and you will be on an improved track towards your goals. Be sure to follow WealthStep at Twitter, Facebook, and YouTube to get helpful tips and reminders as you go along the path. WealthStep will remind you to update your plan and test your savings and your investment selections over time to help you stay on the right path. Thank you, and best of luck towards financial independence. WealthStep can help you along the way.